This is me, and this is me at one of the world's largest stock exchanges, where companies come to go public, also known as IPO.
IPO.
IPOs. IPO.
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 Out of the IPO. Get in on IPO day.
The IPO market.
Being an IPO surge.
The biggest software IPO ever.
An IPO is like a wedding day. There's high expectations, lots of uncertainty, and depending on who you marry, you could become very, very wealthy. An IPO has the potential to be one of the most life-changing days, completely reshaping the trajectory of your life.
A lot of millionaires and billionaires were minted today.
This is one of the most coveted locations for startup founders and employees, as generational wealth is often realized right here. Going public is often romanticized, as the lights are often the brightest and the stakes are the highest, but it might not actually make you rich. The only certainty with going public is uncertainty. But how do you even prepare for this potential financial windfall? These are potentially life-altering decisions. When should I sell? How much should I sell? When should I exercise? Maybe you have stock options and maybe you have RSUs. Today, I'm going to be covering the biggest questions you have about what actually happens during an IPO, what they don't tell you about your equity, and how to prepare for and make the most out of the IPO, whether you're an employee or an executive. Let's quickly divide this into 3 periods: pre-IPO, IPO, and post-IPO. Each time frame, I'm going to address the most important thing, which is how does this actually affect you and what to do about it. But you need to understand some overall context, so we're going to start with what actually is going on inside of the company. An initial public offering is where the company is first traded on the public markets. If your company is pre-IPO, that means that your company's stock isn't publicly traded currently. Going public or even a merger and acquisition is something that many large private companies build a clear path toward, an ultimate exit with a bright future. The best candidates for IPOs are typically late-stage companies that have already raised several rounds of funding from VC firms. While certainly not a requirement, it is a common occurrence. They often raise as much as 3 rounds to a Series C before going public. Some companies even raise all the way through a Series G before IPOing. There's also a timing element when companies decide when to go public. Companies will often wait until the market is healthy and investor optimism is high to get the best valuation possible. When the time is right, they'll make the decision to go public. Companies will want to be valued higher at the IPO than its most recent valuation, so that the investors are actually turning a profit. Until there's a large likelihood that the company will be valued higher, most companies will remain private. Know that this isn't a last-minute whimsical decision, but something that companies spend several months or longer preparing for, the rigors of becoming publicly traded. Even if the underwriting process has begun, market changes could cause delays. But how does this affect you as an individual? Up to this point, you probably haven't had much control of the company, if any. This is where your life-altering decisions begin, as we address what's actually in your control. Whether you have stock options or RSUs, you need to start by creating a plan. This is absolutely essential. If there's one thing that you get from this video, it's this: hope for the best and plan for the worst. Here's the financial framework that I have created to help people make financial decisions, and it's especially true to your IPO. Step 1, values and goals. The purpose of your life isn't just to create the largest bank account possible. If you're trying to make the most money possible in the IPO, you'll probably take on too much risk and end up losing money. You need to set the company Kool-Aid aside for a minute and get as objective as possible. Quit daydreaming about the eye-popping amount of money and get serious about what you truly value. What are you really working towards in life? Realistically, you're probably working towards something like a down payment for a house, or funding a child's education, or some sort of international travel. Take note of any large future expenses in the next 3 to 5 years that you may have. If you don't have any goal, now's probably the time to give some direction to your money. The IPO will be an emotional event, and that's okay. Let's plan in advance so that we can be prudent when our emotions are highest. Ultimately, we don't want our temporary emotions calling the shots as the volatile stock market thrashes our company stock and our net worth up and down. And to manage your expectations, just know that you're likely to build generational wealth if you are a top 5 employee, a founder, or if your company raises little capital, or you become an executive at the right time, and or if your company is valued at $10+ billion. Step 2, risk tolerance and capacity. As someone who's worked with tons of startup employees at a variety of tech companies, if I had $1 for every company that said that it had the intentions of IPOing in 3 to 5 years, well, I wouldn't be making this video. Please don't put your whole financial future on the success of your company. Don't expect the IPO to solve all of your financial problems. While your company is pre-IPO, take steps to get your finances in order. Please build up an emergency fund, start funding your retirement, and be careful with debt. You are welcome to drink the company Kool-Aid, but please cover your financial basis outside of work so that you're not completely dependent upon the success of the company. When a private company is eyeing an IPO, please remember that there is no guarantee that it will actually happen. Working for a startup is all about the chance of getting paid out later, and there's risk in that. The risk will affect decisions around your equity. If you have stock options, you're probably wondering if you should exercise. When you exercise, you're locking your money up in the company and are likely triggering taxes depending on several factors. Can you financially and emotionally afford to lock up that much money in both the exercise price and in the taxes? Remember, there is no guarantee that the company will actually IPO or even be purchased. The result is mostly out of your control. If you're close to an IPO, then it would be prudent to wait to exercise because of all the uncertainty around the actual IPO event. But ultimately, it depends on the exercise costs, tax ramifications, and your personal financial situation. Your exercise price won't change during the IPO, but the fair market value will. A lot of people romanticize sophisticated tax strategies and take on unnecessary risk to optimize something that shouldn't even be a top priority in the first place, which is taxes. I've seen people destroy their financial life trying to optimize their post-tax payout. The last thing you'd want to take on is a large tax bill before the stock price drops. Nobody knows what's going to happen, and no one is removed from the volatility of the stock, even founders. You need to be smart and you need to be flexible. Ask yourself, am I both willing and able to take on this risk? Said differently, are you financially and emotionally able to take on this risk? Your emotional willingness is known as risk tolerance. Would a therapist be able to say that you could emotionally afford to see your net worth be thrashed up and down? Would you sleep well at night? Would this risk cause you to become irritable and treat others differently? On the other hand, your financial ability to take on this risk is known as risk capacity. And as a financial planner, if I were to look at your finances, would you be able to afford this risk financially? Elon Musk can afford to lose $10 billion. On the other hand, can you afford to lose $10 billion? No, you can't. The risk of exercising wouldn't be as bad if you could just sell your stock to cover the costs. But there's one thing that pre-IPO companies lack, and that is liquidity. The lack of liquidity really heightens the risk. If your company is still a bit away from the IPO, liquidity is most likely going to be rare. There may be an occasional tender offer or some sort of secondary, but it probably won't be happening super close to the IPO, as that would be a little redundant to be raising money right before an IPO. If you have restricted stock units or RSUs, you'll likely have to wait for the IPO, as your RSUs probably have some sort of double trigger vesting schedule, dependent on some sort of liquidity event such as an IPO. Step 3, financial merit and taxes. Understanding your equity is a great place to start for the next step, which is strategizing. Do you have incentive stock options or RSUs? Are they vested? Does your equity have a double trigger or a single trigger? You'll want to read through your grant documents and your company's equity plan, as this will help you understand what you have and their restrictions. I would be running tax and financial projections, understanding if you have the resources and risk tolerance to exercise. Avoid complicated hypotheticals. When planning, I just like to keep it simple and run 3 projections. Go to both extremes: the best case scenario, the worst case scenario, and something in the middle that's more likely to happen. This will help prevent you from anchoring to some unrealistic expectation. While the company is private, it may be a great time to exercise company stock, especially if the stock is cheap and before any serious appreciation happens in the stock's value. When the stock price is low, there's little spread to be taxed, and you could potentially avoid AMT if applicable. In order to strategize, you'll need the right kind of professional in your corner to help you. Coordinating complicated financial, tax, and estate strategies require a level of sophistication that you can't learn in a blog post or 2. If you're an early employee, pre-IPO can be a great time to do estate planning. One of the strategies that an attorney can help with is creating a trust for something called tax stacking, which is a tax planning strategy specific to qualified small business stock, also known as QSBS. Eventually, you may need a securities attorney for creating a 10b5-1 trading plan, which is mostly reserved for executives. A good CPA can help you file your taxes and tell you how much you owe. The problem with that is that they're reactive, not proactive. A good financial planner who specializes in equity compensation can even help minimize your tax bill through proactive tax planning and help you diversify your investments. That is why I created my wealth management firm to do proactive tax planning and financial planning for owners of equity compensation, such as ISOs and RSUs, to ensure you optimize your equity and minimize your taxes, no matter your situation, whether you're pre-IPO, IPO, or even post-IPO. Okay, now that we know what to do pre-IPO, let's talk about the actual IPO. This is the IPO paperwork, formerly known as the S1. If the IPO is the wedding, then the S1 is the engagement. The S1 really kicks off the IPO process. It's the catalyst, if you will. I've also heard the S1 being compared to being the center of the IPO solar system, and everything else just kind of evolves around it. When your company files this S1, it signals to the public and to investors that the company is actively pursuing an IPO. But just like a wedding, engagements can be broken off before the wedding actually happens. There's no guarantee that the S1 will in fact lead to an IPO. It's only a moderate indicator of an IPO being around the corner. The S1 is hundreds of pages explaining the company's history, its executives, and its past financials, and also, perhaps most importantly, the risks associated with the investment. To a certain extent, it's like a pitch to prospective investors. This will be filed with the help of an underwriter, for example, Morgan Stanley or Goldman Sachs. The underwriters help guide the company through the IPO process, just as a father would escort the bride down the aisle. Just like weddings have to be officiated by clergy or certified officials, the Securities and Exchange Commission officiates this wedding between the private company and the market. The S1 won't actually tell us when the IPO will happen. You'll likely only learn about the actual date of the IPO only a few days before it goes public. But can the S1 filing actually give us any insight into when the IPO will actually happen? Not exactly. The time between the S1 filing and the actual IPO of the company can be based on several factors: the SEC feedback or the SEC comment letter, market conditions, financial performance, regulatory challenges, and so on. It usually takes a month for the SEC to review the initial S1 filing, but they may request changes be made before they actually approve it. Filing these amendments using the S1A or S1 amendment can take time. Once approved by the SEC, then the company will try to attract investors by going on what's called a roadshow. This is where they market the company's stock, and it usually takes about 1 to 2 weeks. There's one more thing that companies will do before actually going public. Once the effectiveness of the S1 takes place, the company is going to make changes to their equity compensation plan. They'll do this by filing an S8 with the Securities and Exchange Commission. Companies often do a complete restructure of their equity plan to become more competitive in the public markets. In private companies, for example, executives are often concerned about the private investors who are funding their private company, whereas public companies are more concerned about creating shareholder value. These private investors and public shareholders each have very different expectations around the executive's pay program and the equity. Therefore, companies often do a complete refresh of their equity before IPOing. It's also easier for companies to get their new equity plan approved by private shareholders while the company's private versus when the company's public. While the equity grants are incentivized to retain key executives and employees, just know that the future grant may not be similar to your previous grant, for better or for worse. The grant will be based on a combination of other peer companies and recent IPOs. The stock exchange that your company will be listed on, oftentimes the NASDAQ or the New York Stock Exchange, they will invite the founders, executives, underwriters, or other key shareholders to the ceremonial ringing of the opening bell. The company is officially public, but what does this all mean for you? First, let's take a step back to when the S-1 is actually filed, as that's the catalyst to your company going public. When the S-1 is filed, it's public information, so you'll know when your company is serious about going public. So what should you do once the S-1 is filed? If you're an executive, the filing of the Form S-1 begins a timer for your company's management team, aka you, where you aren't allowed to express any opinion on the value of the company. This is known as the quiet period. This period starts from the filing of the S-1, also known as the registration statement, and continues until 40 days after your company debuts on the public market. You may also want to create a 10b5-1 trading plan, which protects you from any insider trading allegations. The main rule with setting up a 10b5-1 trading plan is that you can't actually have any non-public information about the company. And when you file your S-1, you disclose so much about the company that it makes a great time for you to actually create a 10b5-1 trading plan. But let's talk about your equity. If you're able to exercise your stock options, I'd seriously contemplate waiting. When your company IPOs, it's unlikely you'll be able to sell your stock. Waiting would be prudent here until you're actually able to sell your stock. Something to note is that the tax rules don't change surrounding your equity just because of an IPO. RSUs will still have ordinary income upon vesting, and stock options will still have to report the spread on the exercise as either ordinary income or AMT adjustment, depending on the type of equity. Unfortunately, you probably won't be able to sell the shares to cover taxes for 6 months. You'll likely owe quarterly estimated taxes before the April 15th tax deadline. This can be bad news for owners of RSUs because your RSUs will likely vest upon IPO. RSUs typically have a double trigger, the first one being the length of employment. The second is likely to be a liquidity event like an IPO. When RSUs vest, you'll owe taxes on the gain. So there's a potential to owe a large tax bill without the ability to pay it. Or even worse, you could owe a large tax bill on worthless shares. This is why I'd strongly consider waiting to exercise until you can sell your stock to cover the tax bill. Once your company goes public, brace yourself for uncertainty. A recent NASDAQ study of companies that IPO over the past few years shows that 80% of companies have a negative cash flow. While that's not necessarily a guarantee of future performance, it is still pretty scary to have high expectations on such a company. I'm not saying that you can't take risk here. I'm encouraging you to take an appropriate amount of risk depending on your risk tolerance and risk capacity. Chances are it could have dropped by the time you are able to sell. So stick to a plan. Not every IPO will go up. If it does go down, it may never come up. Or in the case of Facebook, it took a year for it to recover to its IPO price. Everybody has expectations for their IPO, and a 50% drop isn't one of them. Nobody's rich yet, except for the bankers and underwriters that helped your company to this point. Here's why. The underwriters that help take the company public will take a healthy fee, and then they typically purchase the first block of shares before the IPO. And as a way to protect their new investment, they create some rules for all pre-IPO shareholders. The most well-known of them is the lockup period. And the lockup period is a time frame where you're restricted from engaging in any transaction with the stock, typically 180 days long. And if you're lucky, it could be shorter, but it's typically 180 days. Sometimes they restrict your ability to pledge, transfer, offer, exercise your stock options, but most of the time they just disallow you from selling your company stock. It's important to note that if you exercise during the lockup period, taxes aren't delayed until after the post-lockup, they're often due sooner. To be clear, the lockup period isn't the SEC or the IRS imposing this, but underwriters or bankers who are protecting their investment. That means that if your company goes public through a direct listing, like Slack and Spotify did, there isn't a lockup period. Direct listings don't require an underwriter because the company doesn't create new shares. It uses already existing shares. In addition to the traditional IPO process and direct listings, there is one more way that a company can go public, and that is called a special purpose acquisition vehicle, or SPAC. In the traditional IPO route, a private company raises capital through selling newly issued shares to the investment banks or the underwriters. These bankers then sell to institutional investors. This allows the private company to be more picky with who their initial investors are, and they also get help and other assistance from these underwriters. This can be a more expensive and time-intensive route to IPO. To circumvent these fees and other business-specific reasons, a company may choose to take the direct listings IPO route. The direct listings route allows shareholders to sell directly to the public without raising any new funds in the process. Companies typically need to have a strong brand recognition if they choose this route. Again, for example, let's say Spotify, who did this or took this route. Lastly, a company may choose to IPO via SPAC if they're looking to raise a specific amount with a strategic partner in like a shorter time frame. They can do this a little bit faster. And so SPACs are also known as blank check companies because they are a shell company that merges or acquires this private company. The combination of these companies through a de-SPAC merger results in the company going public. They receive proceeds from both the IPO and from private financing. Regardless of how a company IPOs, they'll eventually start to grant new shares under the revamped equity plan. And they will also build out the insider trading policies. You can learn more about the new equity plans by looking up Form S8. First and foremost, congratulations if you've even made it to this point. I recently had a client explain their liquidity experience as validation for picking the right company. There's risk in joining a startup, and very few of them ever make it to this point. Once the lockup is complete, it now makes sense to look at the stock price. If you'd like to exercise some of your stock options, you want to ensure that your options are above water or in the money. That just means that the fair market value is higher than the actual exercise price. If you do choose to exercise your options, I'd invite you to do a net exercise or a sell to cover so that you actually have enough proceeds to cover the tax bill. Assume your stock isn't going up and pay your taxes now. Please don't wait until tax time to sell. I've had clients go against this advice because they thought that they would wait for the stock to go up before selling and paying taxes. The problem is the stock didn't go up. They had a large fixed expense in the tax bill and decreasing stock price from which to pay it. Don't try and outsmart the system. Be conservative and play it safe. You'll have a coworker or two who are dumb and accidentally guessed right. If you tell them to do it again, chances are they won't be able to do it. It's not a direct correlation between effort, skill, and wealth. Dumb people will get rich here. Smart, hardworking people may not get as large of a payout. It's not about other people. Don't compare. If you do, you'll either feel bad about yourself or you'll get confident and take dumb risks, neither of which is a great option. As you make decisions around exercising and selling, you'll want to ensure that you're aware of trading windows and blackout periods where you're not allowed to trade. Also, if you're an executive who needs to create a 10b5-1 trading plan, it's now your job to keep the rules that the plan established. Be aware of insider trading policies, as these fines can be multiple of your actual stock. The SEC doesn't joke around here with this stuff. It's not a slap on the wrist. When you do sell, you can be strategic about what shares you sell to reduce your taxes. Your shares will likely have different cost bases and holding periods. If you're in a high income tax year, then it may make sense to sell high cost basis stock with long-term holding periods. To the contrary, if you're in a low tax bracket this year, you could consider selling low basis stock with short-term holding periods if it aligns with your unique goals. Once you sell, you want to do a couple of things. First, take care of your taxes. Ensure withholdings are accurate as you start selling shares. Second, you'll want to diversify. Your income is already tied to the company. We don't want your whole net worth tied up too. Will the difference in having 100% of your shares in the company and 75% of your shares in the company actually make a difference in you making it? Probably not. That's why I encourage my clients to sell 25% of the shares as the lockup period ends. There are different approaches here that you could take. You could sell a fixed amount each year or sell at a specific price point. The IPO may create wealth, but diversification can keep it. If you still have RSUs vesting, it usually makes sense to sell them as soon as they vest. It's common to view the vesting of RSUs as a cash bonus. If your company had given you a $50,000 cash bonus, or whatever your RSUs are currently worth, would you invest that money back into your company? Probably not. Whether you made it big or not in the IPO, you need to stick to the plan discussed earlier. If you didn't make it big, it shouldn't be cause for concern because hopefully you've already been staying on top of your retirement contributions, emergency fund, and so on. If you did make it big on the IPO, continue to stick to the plan. Just because you can afford something doesn't mean you should actually buy it. Be smart with your money and catch up on any key financials you're behind on, such as funding a child's education, reducing unnecessary high interest debt, and so on. Whether you made it big in the IPO or not, just remember that the wedding, or IPO, is just the start of so much good to come. Thank you for watching.